Great, well, welcome everyone. I think my head is going to swell now because this is definitely the largest crowd for a live Markets Happy Hour podcast. Maybe making it a little early. It is not as happy as it would be at 5 o'clock, but I think where we are May 1st, I think we can safely say we are feeling a little happier, certainly than I've been expressing over the last few weeks. We've come into a new month with the previous month, quite a lot of turmoil. And it is the previous month's turmoil has resolved itself essentially in the same place that we started. So that's, I think, cause to be happy, even if there is quite a lot that's changing beneath the surface. So welcome to our guests. This is why we do live podcasts, to have guests in the room that can contribute to the conversation. No pressure, but if anybody would like to ask a question, put in a objection or agree, if you violently agree with something, please do so, because that's exactly how we make these live discussions make sense. So every week we do this and we go through the usual 5 fingers of the hand. We speak about inflation, interest rates, equity markets, geopolitics, and other. And the other asset classes have ranged from gold to Bitcoin to property. We talk about oil a little bit today. And the idea being is that these are really the main aspects that we would think about when we think about like what has just gone on, what is the kind of the skeleton of what's just gone on in markets for the past week. And we always ask this with a view to what does it mean for our portfolio, the kind of so what question. And there are a couple of topics. We've got a few cuts and scrapes on the economy after what has just been a very turbulent month of April. We can look at the hard data and say that that is kind of good-ish. It's not quite as bad as you might expect given where we've been. The soft data, though, is showing some real decline in terms of sentiment, and we need to talk about that. We're in the middle of earnings season. Earnings have been, we thought, telling us one story, and now it seems like they're telling us a different, much rosier story now that the big tech stocks are starting to deliver their earnings. And then the question is, where do we go from here? It's May 1st, the beginning of a new month. Typically it's sell in May and go away. We've certainly had a lot of that action already this year. So are we more at a point of buying in and taking advantage of some compelling valuations? Or as I described it today, on a very last minute Bloomberg appearance, it's like, is it time for the retail investor to get back on the horse? Essentially, they've been knocked off, they've seen some volatility, and is it now time for them to get back on the horse? Starting with inflation, it seems like inflation is definitely in the eye of the beholder at the moment. In terms of its absolute level, we're in a different position here in the US versus where we are in Europe. Here in the US, it's still hovering around 3%, a little higher than the Fed's comfort level. But in terms of what is the inflation expectation, we can see that there is a fear of rising prices that is still very much in the consumer psyche. So the consumer psyche is feeling basically that this tariff rhetoric has been so inculcated into the national media coverage that we are all expecting prices to rise. We've heard the chairman of the Fed talk about that. And this has been behind some of the pulling forward of purchases into the first quarter. And we've seen quite a distortion of first quarter GDP, as well as some of the purchasing activity. Let's talk about economic growth, because economic growth will, of course, drive the inflation going forward. And what we're seeing in US GDP growth, it has been negative for the first quarter, and not by much. And there's a real sense that this slowdown is likely to have some global contagion, and that the IMF is concerned that this off-the-charts trade uncertainty is likely to have quite an impact on the global growth. But the GDP growth alone needs really to be taken apart to see what exactly has gone on. So we've heard about stockpiling. We've heard about jumbo jets filled with iPhones being shipped over from China. These tariffs have been well telegraphed since Liberation Day, essentially. And even though there was a 90-day stay on some tariffs, we knew, especially from China, we knew that there was something very real was happening very quickly. So that kind of stockpiling of and importing has been brought forward quite dramatically, which if we were to look at the trade balance, would look like it had deteriorated significantly, given the volume of imports is far now exceeding the volume of exports. So that has been a driver in the GDP figures, which is going to distort that somewhat. Equally, when we look at where we've seen the most expenditure, we've seen imports of consumer goods, industrial supplies, this is the gold line here, really surge in the last few months. And that's, again, a direct response to the tariffs. But vehicles have actually fallen. And when it comes to consumer goods, ex-autos, we've seen a strong demand. So a very distorted picture that we really need to look through. And those of you who look at these pictures of CPI, inflation numbers, we know we strip out the more volatile components there. We strip out energy, strip out food, and look at what is really the core inflation. So if we're to look again digging into GDP a little bit, change in private inventories has been very strong. Consumers have been, but we've certainly seen a very strong pullback in state and local government, in residential investment, negative federal government expenditure, and just this artificial imports, strong imports, has all contributed to this quarterly change in GDP. So I don't think we can really read much at all into this GDP number. It has definitely been artificially inflated through this kind of stockpiling of goods and these imports, which have been very strong. I'd also suggest that because of this stockpiling, we cannot read too much into the empty cargo ships or this ghost port Seattle kind of narrative that seems to be circulating. It could be true that these numbers are down. I don't think it is exactly a ghost port. But at the same time, a lot of this has to be compared to what we've just seen. So not a very strong, not necessarily this all fallen off a cliff. But when we see that this, basically we've taken hold of this narrative that there is this rush to beat tariffs is distorting the number, and that this is the point I made earlier, that we should really be looking at the core number. So I'd say overall, we shouldn't read too much into the numbers of this quarter. It has been quite unsettled, quite distorted by the policy. But let's look to the future in terms of the forecast of things being negative. We know the Atlanta Fed was immediately ahead of the curve in forecasting negative GDP when that was actually the very time of even the announcement of Liberation Day tariffs. So they did not hold back and immediately went to a negative forecast. This is now still very much in negative territory. So this might perhaps be the kind of the bellwether for where other forecasts are likely to come. But these are all the kind of the economy is not the stock market. I think those two things we have to keep remembering. The economy is still got some quite significant weakness. And moving then to soft indicators, we can see that the US consumer expectations are at a 14-year low. So I've shown various charts like this ahead of other podcasts, and they've all essentially carried the same message, that soft indicators are definitely heading down. Small business confidence is lower. And generally, we see that these indicators will compress and fall lower ahead of a recession. And I think what's most stark here is how quickly they have fallen. So they've only fallen faster ahead of the 1990 and 2001 recessions. So quite a bit of a very fast movement there. And when we move to jobs, in terms of just the more hard data, this is coming out today's Thursday. We're recording Friday's the jobs number. I think we're going to see on the job side probably pretty much stability. But remembering that jobs are looking backwards, we can see that the openings are kind of pretty much stable, as well as the quit numbers being about stable as well. So nothing really dramatic on the job front that is likely to tip the Fed one way or another. So I'd say just a lot of kind of more of the same here, but this will be looking back. I think this is a good time to bring in just some insights from the podcast I did in Europe last week, because in Europe, a big difference in Europe is often said to have consistent headwinds in terms of the lack of innovation, over-regulation, so a welfare state that's getting increasingly expensive to support, and an immigration problem that they seem to unable to address. I will say that this immigration problem within Europe has actually been the reason why they have very cheap labor, and they've maintained cheap labor. And even just comparing the cost of, say, a hotel worker in Spain versus over here, the availability of free healthcare has really kept a cap on the cost of labor. And it's been this cheap labor in Europe that has enabled them to ride through the wave of contraction and expenditure. So that cheap labor has enabled them to provide services for a tourist industry that has been the lifeblood of that economic recovery. So I'd say our jobs picture, yes, it's strong, but our cost of labor is still is becoming anti-competitive almost compared to some of the other countries which have more affordable cost of labor. In terms of rates, not much to say this week. All we can say is that the Fed is sort of remaining unchanged. They're remaining on hold, despite market bets on looming cuts. We know that every time the economy dips, we expect more rate cuts. That seems to have been a trend in the last few weeks. The Fed is still holding firm. We've again, the narrative around the firing of the chairman seems to have receded, given that tariffs have dominated recently and that other news flow and the earnings have dominated. But that's still only a week ago or so that was the suggestion there would be no firing of the chairman. So I'd say that all of that volatility still kind of bubbles in the background. But no change in interest rates at the moment. We do know that Europe has done its 7th rate cut. It's very much committed to using monetary policy effectively to stimulate the economy if it needs to. Moving to equity markets, which I'm sure is on most of your minds, I'd say this is the April that fooled us all, perhaps, in that we did think we were heading into another kind of 2022 type situation. And then we've had this reasonably strong recovery, certainly for the NASDAQ, very much led by the tech stocks. The S&P has almost retraced its gains. And this is all from Liberation Day, or April 1st, so Liberation Day has not gone back to the administration and the election day. We are still underwater when we look at what's happened since Election Day, but at least the bump or the wound of Liberation Day tariffs has not taken too much of a toll. Industrials have sluggishly made their way back up, but it has been a story of tech stocks. So this, I think, will lead to a lot of investors feeling some solace that they maybe didn't exit the market when they could, because they see that this would have been very, very difficult to trade. And if we just look at the shape of that movement in the month of April, very volatile and very difficult to navigate, given the sharp moves that we're seeing and still seeing even today, May 1st, in some of the tech stocks. So quite a wild ride, and the fact that it has been retrenched, I think this gets to some of the point I'll make earlier on about what is it that makes this economy so stubbornly resilient? What is it that's making the Mag 7 so stubbornly resilient? And I think this is kind of a complex issue that two things can be true at the same time. We can have very resilient tech sectors combined with a very weak economic indicator underlying it all. Let's just move away from the US somewhat, because there has been this swing. Last week I spoke about the swing from American exceptionalism to sell America. That is to sell USA, sell everything, the bonds, the dollar, the stocks. And that seemed like it was overdone. It didn't seem like the entire world was all of a sudden rejecting all US assets, but that was a narrative that took hold. Definitely the US equities have recovered ground, as I showed in the previous slide. The interesting point is that the rest of the world has recovered even more. So the rest of the world, interestingly, started to diverge from US equities. If we look at the rest of the world being blue and US equities being black in this chart, they initially, the rest of the world languished post-Trump's election. Then it recovered as the two moved out of in opposite directions once it seemed that tariffs were actually going to happen. And now we can see that the rest of the world has recovered more. And it was interesting to see the rest of the world has been performing better than the US really for the last 6 months at this point. But it has diverged, and it's continued to diverge because a lot of the fundamentals are just different. And I've said this a few times, but I do think that the fundamentals in Europe are, because of this austerity they're used to a certain amount of pain, so they can actually tolerate a bit of austerity. They have this fiscal impetus coming through Germany, releasing the fiscal brake. They also have quite a galvanized support of each other after the gauntlet was thrown down by the vice president in Munich. And it seems overall that Europe is feeling confident about itself and its future. And that mindset shift is tremendous, because it has been challenging to find much confidence in Europe. But the interesting thing is it's recovering even more. So that suggests sort of a lingering problem with holding US assets, or just a lingering distaste for the just general sense of change that's been kind of cast upon the international markets. So still, for those of us who have global portfolios, validation of that global position, a validation of non-US dollar holdings, they will, I think, prove to come through. So we're seeing a really mixed picture in terms of earnings. I start with the good news, because I think that we've certainly had a lot of bad news recently when it comes to earnings. And we know that those words, tariffs and uncertainty, have just been cascading throughout earnings calls. But what are earnings telling us right now? Well, the big seven, the Mag 7, they were called Magnificent 7, they were called the Maleficent 7. It seemed that they'd lost everything. This type of wording is catchy for a headline, but is actually very misleading, because yes, that they were overvalued, and they're still overvalued. They're overall about 50% higher in terms of valuation metrics than the rest of the S&P. But there are probably good reason for that sense for them to stand alone. There are certain good reasons. And as we can see, what has not changed? And I think Jeff Bezos always says, you should focus on not only what changes, but what does not change. And what has not changed here is their commitment to AI, their ability to service that demand, the demand for AI. And Microsoft shares was a case in point today. That went up up very high single digits after hours and continued throughout the day. In the case of Meta, they've seen some strong spending on advertising, which you would think, if the economy is as soft as it is, that this advertising would not be well supported, particularly something as variable since it does come from small business. But maybe it's the online advertising that you cannot cut, because that's where the hits come. Maybe the billboards outside or the sponsoring of a podcast, maybe that is what you can cut. But when it comes to actually wanting to sponsor something like on a Facebook page and clicks, that's the kind of the last thing you will cut in your marketing budget. So Facebook has done well. Amazon, I thought this was interesting. They're investing in rural America, $4 billion to speed up deliveries in rural America. This is going to be music to the president's ears. So clearly there is a lot of, whether it's sound bites that are appealing to the president's ears, but we're seeing this strong performance by the Mag 7, despite which they are not immune from the headwinds. But remembering these are for the most part service companies, so they're not in the cut and thrust of trade, although obviously they are dependent on hardware, as certainly Apple would be later. Then for some of the less good news that we're seeing, beginning of the week we've had this discussion around shipping volume, and this has certainly been the inevitable, the bite of tariffs, because there is a delayed effect, shipping, etc. We know that Shein, Temu have shown already shipping charges, which in some cases are more than the price of the good, getting rid of the de minimis exemption. So this we're kind of watching for this to bite, whether we're going to see empty shelves or not. But certainly the catastrophic thinking and talking has started around that. We can see that GM is they're expecting tariffs to cost up to $5 billion, slashing its outlook. Their stock actually rose today. So I think they thought that this wasn't as bad as expected. So I guess it's markets, as I said, are in a glass half full type of a point of view today. I found it telling that McDonald's sales were dropping. I thought that would be kind of the lowest end of the spectrum when it comes to expenditure. And if that's dropping, then clearly we are in a zone of consumers really cutting back. So a very mixed picture through earnings. And we're not, again, this kind of two-stage or two-pace economy is continuing to rock. I put this is too much to read online, but it can be read. This is a section from Anti-Fragile from Nassim Taleb, because I have wondered about this economy. So what is it that is actually keeping the US economy so resilient, and has been so resilient in 23 as well, when we thought there would be a recession, and there wasn't, and 24 there has not yet been a recession. And there's a suggestion that maybe this basically draws the distinction between resilience and anti-fragile. And Taleb's point of view is that anti-fragile is almost when someone says the opposite to fragile is not I'm resilient, it's actually break me. Not don't break me, and I will be stronger as a result. And there are certain things that actually benefit from being shocked, from being, I suppose, from turmoil. And they say this about bones. When a bone is broken, it repairs and then stronger at the place that it has broken. So suggesting that maybe some of these US companies, and I would say this is also true for parts of Europe, that there's been the companies that have come through this type of resilience are actually stronger again, because they will have backup plans, they will have backup supply chains. We know that's the case after COVID. So I think we need to, I don't want to say definitively that the US economy cannot be broken, but I would suggest that parts of it are actually benefiting from this sheer turmoil that has essentially been unleashed upon it. And I think there's a lot of narrative as well that's gone around this seismic change in terms of our position on the global stage, and whether that will mean that there will never be trust again, that America will never be an ally again. I think that may be a little naive, actually, to suggest that trust is something that is pervasive around the world. I think that most operatives are reasonably cynical about whether a counterparty is likely to fulfill their expectations at all times. And I think if you're not cynical, you would be seen as being perhaps a patsy. So I would suggest that we shouldn't overdo this narrative that things will never be the same again. Nobody will ever trust a US counterparty again. We see that tariff negotiations are happening, perhaps not as conclusively as the president might state, but they are happening, they're starting. And for that reason, there's probably a reasonable amount of acceptance that, this may not be the perfect trading partner, but, we will remain hedged perhaps in this conversation. So I think just this anti-fragility, it has come up time and time again. And I suppose we need to ask, what could it be that would actually cause markets to sink dramatically? Maybe if the Liberation Day tariffs had been without any reining in or roll back. But I do think that is, we should think about what this turmoil, like what will emerge from this turmoil in terms of the stocks, the companies that have essentially now seen it all and lived to tell the tale. I do think that there's, we can see the banks that survived 08, 09 are in the rudest health they've ever been in. So I would suggest that's something. I'd love to hear if anyone has views on any of this in terms of the fragility, why it is that some of these stocks why we are looking at a chart like that I showed earlier in terms of the April stock market. But is this, as I think it was said today, is retail flows just desperate to get back in the hunt for equity returns? Bonds perhaps burning because of being so volatile. Is it? We can see it's not every stock index is getting a bid. But any thoughts or? Go ahead, Riz.
Hi, my name is Riz Khan. I have a question. While you were talking about the job market, comparing with the European market and US market, do you think because of international student in the US, they are finding hard to get the job? Apart from that, the tariff and all these things are happening. Do you think the cost will go up and already the recession may come in the next 6 months if the current administration do not act at the immediate, I mean to say in the next 4 months, then already do you think we'll have a hard time?
It's an excellent point. I think you've got a few issues in there. The cost of labor. And we all know with tariffs and with onshoring of manufacturing, say of t-shirts or shirts or lumber, whatever, that is likely to, because we know that the cost of labor in the US is much higher than, say, Vietnam. So that definitely could contribute to inflation. I suppose they're looking at offsets. The Fed, on the one hand, thinks that some of these tariff-induced offsets are temporary, not permanent. So we don't know whether the tariffs will have prices permanently rise or just temporarily. I do think in terms of the availability of labor, that's something that's been discussed for a while, whether the immigration policy will affect the cost of labor. And we've seen in Europe, they have abundant labor in tourism, for example. Some of that illegal, some less legal, but either way, that has definitely helped them. So I haven't seen the effect of the immigration yet. I think the deportations, certainly the entries are down, deportations are not probably as high as advertised. And I'm not sure they're pinching in the meat packing plants at this time. I haven't heard of that yet. As far as the students and universities, I think what is real here, and we saw this a little bit in terms of the GDP expenditure, is the federal government spending down and the university spending grants. That's all been collapsed. So there will be a pain point there in terms of that low earner, the academic worker, the PhD student. That will be an issue. And the universities themselves are forced to draw on their endowments. So will this lead to a recession? This is the question about whether, we've had so many reasons to have fallen into recession, and yet that has not actually happened. But I showed a chart last week which suggested that by the time you actually call a recession, it's well underway. The stock market has fallen 50%, we're kind of well underway. Kathy Wood today is saying that we've had a rolling recession, which we're now at the end of. So if that's the case, nothing to worry about. We're already out of the recession. So I think it's going to be very interesting to see when and where we call this a recession. And furthermore, if this is an event-driven recession driven by tariffs, it should be shallow and short. So the answer is I don't know in terms of what happens in recession, but I do think we've got so many different factors, including, importantly, the strength of these Mag 7 stocks and just that sheer force behind the demand that they're seeing, that I think that could be an offset as well. But thanks for the question. Any other thoughts or word from the ground? Some of us have clients here in the trenches, running small businesses, buying, sourcing inventory. Concerned. I had one of these has held at a bakery where the bakery chain owner was line by line, cost of eggs, cost of flour. It had become extremely visceral and real.
I'll just make a comment to your point earlier on consumer confidence. I think what I'm seeing, clients are nervous on what this is going to look like, but I think it's even deeper. We're seeing it hit not just the tariffs, but university funding's going down. I've talked to a lot of not-for-profits. They're struggling with their funding and what that's going to look like. And I think all the uncertainty that you're feeling across so many different sectors is really hitting consumers in a lot of different ways, not only from the business side, but then the personal side. So I've seen a lot of recessions. I think this one's interesting because the consumer is right now, I feel very skeptical and concerned about what's really going to happen and how this is all going to end up playing out. And until we get certainty, you're just going to, I think the risk of potentially a recessionary environment is probably pretty big until there's some call of what is this going to look like.
Yeah, and thank you. And I have some more charts here just talking about savings rate. The savings rate is low. I said this one, that one there, is that savings rate is, you can see it spiked during COVID, but it's now about 3.5%. So there's not a lot of buffer there. We had the COVID savings that were fueling the entry. They were kind of buffering some of the expenditure. That's been difficult. And then if we also look at some of the other expenditure, just going this way in terms of the house prices, can see that house prices, it's been reasonably well supported, but nothing fantastic in terms of a rebound there in terms of house prices. So I think we are seeing mixed. And the other thing I think that we shouldn't overlook is a lot of individuals are concerned personally if they're dual citizens, or they're concerned about their status or the status of their children, or whether they should own property abroad or dollar. And this, I think, that the lack of perhaps consistent messaging, because of how politicized most of this the messaging has become, that has become difficult to know what's actually true. And I think one thing we should point out when we start geopolitics a little bit is the discussion of just how the geopolitics has been transformed by US policy. This doesn't mention the Canadian election, but since then we've seen the resounding comeback of Mark Carney, the Liberals in Canada, completely driven by, I think, the 51st state almost taunting that was going on of Canada, and Canada rallying strongly behind a message, but equally a Liberal that had rolled back some of his more extreme, say, carbon tax initiatives. So that was interesting. We see that on the geopolitical stage, this, besides the good news on the UK, the US-Ukraine natural resource deal, there's quite a bit of I'd say, chaos still pervading on the global stage. We're not paying as much attention to it. It has not been resolved. It's still there. It's difficult to fix. We can see that this, there's not, like, the wars have not stopped, and we're seeing a campaign against the Houthis, and in ways they've actually got more intense and more challenging. So I'd say that has become a bit of an issue. So just to finish off on the equity markets, Tesla clearly a great example of what happens when you mix politics with business. It doesn't always go well, particularly in this kind of very divisive political climate. And latest report about being reported to be looking to replace the CEO, that now seems to have been debunked as fake news. So it's very difficult to know exactly what should be believed when it comes to anything that is being reported. It seems like everything has an angle. I thought this was somewhat interesting. We've done a little bit of looking back at presidential approval ratings, and this has been a 100-day look back that's just happened, and when we're speaking on the political side. There has been Trump looking back at other first quarters and GDP growth, and we've talked already about the negative GDP growth in the first quarter here. That Obama had also negative first quarter GDP growth. Clearly that was a carryover from the crisis at the time. And we saw that George W. Bush also had negative GDP growth, but the rest of the presidency, it all tended toward being positive. So I'm not sure how much this really tells us, given that we have a different reason in every case for having GDP growth, negative or positive, but it is somewhat reassuring that we're at least not locked in to a similar kind of performance. Also, I wouldn't say we're necessarily locked in to seeing approval ratings being as challenging as they are. So just moving towards a few more slides here, I think I've talked about speaking about other areas, and one of the really interesting factors, which I think is, we've spoken about the fixed income market giving us a signal as to the economy and where we go. The oil market seems to be giving us another signal as to expectations around the world for economic growth. And the S&P Energy Index, since Liberation Day, has languished at a negative 14%. So whereas the S&P is broadly back to where it was before, to see the energy price so low and the crude price so low, it's going to be good for inflation. It's going to be good at the pump, but it's telling us something that clearly there is a concern about the level of global growth. I do think it was quite interesting, the blackouts in Spain. I spoke about Spain and its economic strength, and that came just the day after an announcement that they had had one day midweek where their entire electricity was supplied by renewable sources, which was being midweek, busiest week demand, was seen as a real triumph or just an accomplishment, a milestone, followed by the blackout, which I think was purely coincidental. But it didn't help the narrative around the need to build in latency, at least into the system. And then I think this was the lessons we've seen from the blackout. And then gold, clearly a very strong story on gold, but falling back a little bit in the last day of the month there, just as we clearly behaving in counter direction to the stock market, and that's been something we'd expect to see. It tends to be a safety asset. It's been where we've seen investors flee in the aftermath of a flight out of the dollar, but that's been doing quite well. So lastly, to leave you with, just getting back to that idea around anti-fragility, I suppose instead of thinking that stressors are bad, this idea that complex systems are weakened, even killed when they are deprived of stressors. So I would say that one thing that is for sure is that this is an extremely complex system. We've spoken about all the different drivers, the AI, the need for energy, the need for the consumer that still is feeling that needs to buy risk assets, as well as the tariffs and that kind of longer term, shorter term thinking. So it's very complex. It's very difficult to give an answer either way. And I think that instead of thinking of stressors as devastating, likely to lead to collapse, I think let's think of them as not only at a country level, but also at a company and at an executive level. Because certainly executives, this is not their first rodeo either. Diane, you've spoken about seeing many recessions. Some of the grey hair among the executives have also seen many recessions, and they've innovated around that. So I think that gives us some, just in terms of repositioning and rethinking how we think about stress. I think that's it. And there's my disclaimer, which I must leave up for a few minutes per our compliance department. So thank you, everyone, for your participation and insights, especially from the ground. I appreciate that. I'm happy to take any questions or take this in any direction. Anthony, or not to put you on the spot, but any thoughts or what's on your mind when it comes to what we're seeing today?
No, so I think it's very interesting that you brought up these flares or these false things that are coming up that are not kind of going out, that we're in this dynamic where we're in these deal sessions that we have to kind of walk our way through. But no, I mean, it's just, these volatile times are just very interesting to me as a runner of a nonprofit in Chicago. It's just some challenging times as we speak to our funders, and as we speak to how we're just going to continue to run our programs. It's just very interesting and somewhat troubling times for my industry.
It is, because I think we hear about DOGE being cut back or costing more than it saves, or certainly not saving the amount, but the freeze of grants and besides the obvious cuts, I think it's the lack of future spending that's very questionable, and I think that is the pain point that has not been fully trickled through the economy yet. But I know other nonprofits are in, and we can see the university endowments being forced to, these are the kind of knock-on effects. They will be maybe forced to sell part of their portfolio to fund their school that's no longer getting the grant because it's been frozen. And equally, nonprofits have contributed to supplemented government spending in many areas, poverty alleviation or education, etc. And now, if those dollars are no longer there, we may not feel it today, but it's this the long-term effect that I think is an excellent point. So, thank you. Great. Well, I think if there's nothing else to say, we will, I'll say, have a branded cookie, and it's as happy as you can get with the drinks on offer. And thank you for coming. Appreciate it.